Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site, we have Steve Houston. He's a partner over at M Plus Funds. We're going to take a look at defined outcome investing. Steve, it's great to have you with us at the market site in Times Square. Give us an overview of what defined outcome investing is.
Defined outcome investing is somewhat of a new category. The funds that we've been issuing and a few competitors have been issuing these for a couple of years. They're funds that are linked to specified ETFs that people commonly use in their portfolios, SPY for S&P 500, EFA for European exposure, for instance. But our funds provide enhancements to those ETFs, enhancements that come in the form of enhanced upside capture, or in some cases for the more conservative investor, one-to-one upside, but principal protected downside. And all of our funds have a defined maturity date that are aligned to that investor's goals or their specific market outlook.
All right, now recent research from UBS Wealth Management found that U.S. investors are 23% allocated in cash. That sounds really high to me. Is that consistent with what you're hearing from advisors?
Yeah, definitely. With the market at these elevated levels, people are taking a more conservative orientation, so that data doesn't surprise me. Cash is kind of the enemy to the investor, though, so you have to, with inflation, of course, and with relatively low money market rates, there's not a lot of alternatives, for getting yield out of cash, and so a lot of those advisors are using, for instance, our defined outcome preservation funds. These are funds that offer principal protection, but provide market upside, and so most advisors and clients know they need to be exposed to the market, but understandably, principal capital preservation is paramount for a lot of these clients.
So this risk aversion attitude is not really impacting demand for M Plus funds since you do have this preservation portfolio.
Yeah, to the contrary. M Plus funds is kind of a toolbox, and so we launch funds, we can launch them very rapidly within a week almost, and in very small size, and so for clients that want to be exposed to the market, but again, maybe capital preservation, as I mentioned earlier, is really important to those clients, they'll use our preservation funds. Great way to deploy excess cash into the market with daily liquidity, but knowing that if the market was to take a downturn, if we hit a recession, something like that, the capital is preserved, but they still have market exposure.
All right, now to wrap up here, what's your outlook in terms of growth for defined outcome investment products?
It's growing rapidly. We started launching our funds at M Plus Funds about 2 years ago. There's been a couple of really large competitors that have now entered the market, which frankly we're happy about. It just validates the space. And if you look at the ETF landscape, the ETF world has been kind of sliced and diced beyond belief. The assets continue to flow in. What we're trying to sort of promote with advisors and clients is stick to your core ETFs that you're using, as I mentioned, SPY, EFA, kind of the big ETFs, but customize your views around them now. If you are bullish, you might be interested in our M Plus Fund growth funds that provide one-to-one downside but enhanced upside, allowing you to outperform. If you're bearish, that I just mentioned, our preservation funds are really great for investors, get you exposed to the market, but gives you the capital preservation that you're looking for. So I think I know we're growing. Certainly it's good to see competitors entering the space, and it kind of validates the growth in the whole segment.
All right, Steve, thank you so much for joining us at Market Site. And thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.